If you've ever asked yourself, how should I invest for the long term? You're not alone. Investing can feel overwhelming, especially when there's so much conflicting information out there. And depending on who you listen to, you'll hear all kinds of answers. So in this video, I want to unpack 3 major investing strategies, explore the pros and cons, and look at how they've performed historically. Let's start with dividend investing. This is an investing style that's really popular here on YouTube. And many people find out about investing like this through videos on the topic of passive income. The idea is simple. You buy shares in companies that pay dividends, which are payments of cash given to shareholders. And the more shares of a company you own, the more dividends you'll receive. And if you have enough shares, you can even use the dividends to pay your bills and maybe even never work again. And what makes this strategy appealing is that it gives you immediate cash flow from the companies you invest in. Every quarter or semi-annually, you can collect a payout, which can either supplement your income or be reinvested to buy more shares, which helps your investments compound over time. For example, let's say you own shares in a company like Unilever, which is one of the longest running stocks in the UK that pays a dividend. Historically, its dividend yield has been around 3%, and this is the percentage of cash that you'll get paid each year depending on how much money you have invested. So let's say you have £100,000 worth of Unilever shares. 3% of 100k is 3k, and this is how much you would expect to be paid in dividends each year. Now, Unilever pays dividends semi-annually, so you'll get £1,500 every 6 months, which works out to about £250 per month if you spread it evenly over the year. Sounds pretty good to me, and you can see why loads of people like to invest this way. It's about as close to a passive income as you can get, because all you need to do is own the shares and you'll get paid. Now, from a broader perspective, dividend investing is also often less volatile than growth investing, because many dividend paying companies are mature, cash rich businesses. In fact, dividend investing is popular because companies that pay a dividend tend to be larger, profitable, and well-established ones. The idea is that as a company ends up getting really big and generates loads of cash profits, they have nothing better to do with the cash. And so you as a shareholder are entitled to your share of it. So rather than a company deciding what to do with the money, they give it back to you as the shareholder. And then you can do whatever you like. Sounds great, and you could argue that this is what being a shareholder is all about. Also, over the long run, if you buy dividend stocks, the idea is that you can also buy more of the same shares with your dividends. You might hear this referred to as the DRIP strategy, which means dividend reinvestment plan. And if you can do this for many years, you can end up with loads more shares in the same company, which, if you're following along, should also mean that you're getting bigger and bigger dividends. Then once you're ready to start taking the dividends and now reinvest them, they could end up being your passive stream of income, which pays for all your bills. This all sounds good in practice, but just before you get carried away and go all in, I do need to run through some of the cons. Firstly, here is one thing you need to know about dividend stocks if you're a long-term investor. If all you care about is the total return over 10, 20, 30 years, you want that number at the end to be as big as possible, right? Well, dividend stocks tend to be slower growers, which means you're not going to see huge returns like some tech startups. And chasing very high yields can be risky because the sky-high dividend sometimes signals a company in trouble rather than strength. Secondly, if you only invest in stocks that pay a dividend, you're going to miss out on so many other companies that don't pay a dividend. For example, think about some of the biggest companies in the world, like Meta, Netflix, and Amazon, who've all given their shareholders huge amounts in gains over the years, but don't pay a single penny in dividends. In fact, here is an interesting fact. There are over 4,000 companies listed on the major US stock exchanges, but of those, only around 2,400 pay a dividend. That means around 40% don't pay anything at all. I don't know about you, but I definitely don't want to invest and miss out on 40% of stocks just because they don't pay a dividend. That's a pretty quick way to end up doing badly as an investor. Also, we have to remember that a dividend is not some magical free money. It's part of your return as a shareholder, but it's not the most important thing, because investing is all about total returns. Without going into too much detail, remember that as soon as a dividend is paid, that money gets removed from the share price. As an example, let's say a company has a share price of £10. And they pay out a £1 dividend per share. On the day they pay that out, the price of the stock will fall to around £9. There is no free money here. £1 plus £9 gets us back to the £10 total value. And don't forget about taxes too. Every time a dividend is paid, you're liable for taxes, unless you're using some kind of tax protected account. And that applies whether you reinvest it or not. Now look, I get why dividend investing is appealing. After all, it's often pitched as a reliable way to generate income, especially for retirement. And that might be true, but for younger investors focused on building long-term wealth, I would argue that there are more effective strategies to consider. So let's talk about the next strategy, growth investing. After all, this is what investing is all about, right? Putting your money into companies that grow super quickly and then seeing their share price rise up to the moon and beyond. Growth investing is the polar opposite of dividend investing. Instead of taking cash out of the business, companies reinvest profits to fuel expansion. This is where you find your Amazon, Tesla, and Nvidia. Firms that prioritize scale, market share, and innovation over immediate payouts. The potential upside is huge. For example, over the last decade, the S&P 500 Growth Index, which includes only those companies classified as growth stocks, has returned roughly 15% per year, outpacing the overall market's 12% annualized gain. So the point here is that if you pick the right growth company early, you can see returns that outpace dividend stocks or index funds. But growth investing isn't for everyone, because it can be extremely volatile. Think about all the companies that went bust or struggled over the last few years. Loads of so-called growth stocks went public in 2021, but very few survived. Many only made it because interest rates were so low and borrowing was cheap. When that changed in 2022, lots of them collapsed. In fact, the S&P 500 Growth Index as a whole fell about 27% in 2022, which is a sharp reminder that high potential often comes with high risk. On the other hand, don't forget that some of the biggest companies in the world are still growth stocks. Microsoft, worth almost $4 trillion, is still expected to grow year after year. Or take Monster Energy, the best performing stock in the market ever. It's delivered more than 80,000% gains over its lifetime, beating almost everything else. And it's not even a fancy tech stock. So if you want a balanced portfolio, surely you want a mix of growth stocks and dividend stocks. But here is the hard truth. Picking them is tough, and they often require more attention and monitoring, because poor earnings reports or shifts in market sentiment can cause dramatic swings. Also, unlike dividends, you're not getting paid along the way, so you need patience, conviction, and sometimes a strong stomach during downturns. That's why picking individual growth winners consistently is extremely difficult, and why many investors prefer diversification. And this takes us to the next strategy: index fund investing. Index fund investing takes a different approach entirely. Instead of trying to pick individual winners, you buy the whole market, which means they come with built-in diversification. So you're spreading risk across hundreds or thousands of companies, reducing the impact of any single company failing. And because these funds are passively managed, expenses are typically very, very low, meaning more of your money actually compounds over time. Historically, this approach has been incredibly effective. The S&P 500 has delivered an average annual return of roughly 10% over the past 30 years. This includes major crashes, tech bubbles, and recessions, and it still produced long-term growth for investors who stayed the course. Also, from a psychological standpoint, index funds are less stressful. You don't have to agonize over picking the next Tesla or worry if Coca-Cola cuts its dividend. You're buying the market and trusting that over decades, the market grows. Index funds have beaten the majority of retail investors and even most professional fund managers who charge high fees for their so-called expertise. Here is some data from JP Morgan. The average retail investor earns just 3.6% a year compared to the S&P 500, which massively outperformed. So ask yourself, would you rather gamble on being a stock picking genius or buy the whole market and never worry again? To me, the answer is clear. But it's worth saying that some investors also combine approaches to have a mix of everything. For example, you could hold dividend stocks for stability stability, growth stocks for high upside, and index funds for broad market exposure. This hybrid strategy balances risk and reward across different market conditions. But the reality is there is no single best strategy for everyone. It depends on your goals, risk tolerance, and timeline. The most important thing is finding a style that works for you. It could be dividend stocks, growth stocks, index funds, or a mix of all three. What matters most is sticking with your plan for the long run. For most long-term investors, the evidence suggests index fund investing is the simplest and most reliable path. But blending in some dividend or growth exposure can add some flavor, income, and potential upside. For me, most of my long-term portfolio stays in a low-cost global index fund. But no matter what approach you take, the goal is the same, making sure you have enough for a comfortable retirement. So watch this video next to learn about 2 key things that you shouldn't ignore about investing. Otherwise, you may not have enough to retire. See you there.